Hello, everybody. This time we are talking about venture capital. Venture capital is a type of private equity used to support startups and early stage companies with the potential for substantial and rapid growth. Venture firms raise funds from limited partners to invest in this high potential business, often providing not just financial backing but also technical support and managerial expertise. In return for their investment, venture capital firms gain ownership stakes in the companies they support. Venture capital is typically introduced at various stages of a company's development, such as seed and early funding rounds, and plays a critical role in driving innovation and expansion across industries. And then, how does venture capital work? Businesses can often expect venture capital investment to be delivered across multiple rounds. Venture capitalists, often in collaboration with other investors, acquire minority stakes in businesses. Early stage companies typically secure funding through a series of investment rounds, Series A, B, C, and so forth. Each round will involve either existing or new investors injecting more capital to support the company's growth and can raise millions. In addition to these rounds, many startups also gather funds before Series A through various venues such as investment, crowdfunding, grants, incubators, or even contributions from friends or family. Seed round investment is typically offered for proof of concept and can be several hundred thousand pounds. This collective process is commonly referred to as the innovation ecosystem. This system facilitates the position and provision of both capital and business expertise to fast-growing early-stage companies at various stages of their life cycle. Venture capital firms generally retain their investment for a period ranging between 5 to 7 years. After this period, the company may go public on the stock exchange, get acquired by a multinational corporation or another investor like a private equity system. And then we move to stages of venture capital financing. The first stage, pre-seed stage, is capital provided to an entrepreneur to help them develop an idea. Many entrepreneurs interested in raising venture capital funding will enter business incubators, which provides various services and resources for entrepreneurs to connect them with venture firms and networks that will help them develop their business idea and product. Then, second, seed stage capital. Seed stage capital is the capital provided to help an entrepreneur develop their idea into an early stage product. Seed stage capital usually funds the research and development of new products and services and research into prospective markets. And the third Early stage capital. Early stage capital is venture capital provided to set up initial operation and basic production. Early stage capital supports product development, marketing, commercial manufacturing, and sales. And then fourth, later stage capital. Later stage capital is the venture capital provided after the business generates revenues but before an initial public offering. It includes capital needed for initial expansion, capital needed for major expansion, product improvement, major marketing campaigns, mergers and acquisitions, and capital needed to go public. And then we move to the benefits of venture capital. Venture capital provides several potential benefits to both investors and those receiving venture capital investment, such as the first, potential for high growth. The funding from venture capital gives portfolio companies crucial capital that they can use to stock up on inventory, advertise, hire staff, or anything else they want to use the funding for. That can lead to substantial growth, especially considering the starting point. And then we move to the second, expertise and guidance. Because venture capital investors often take more of a hands-on role with their portfolio companies than traditional stocks owners. They can help startup founders gain a competitive advantage and overcome obstacles that new companies often face. That can help in terms of investment performance, and venture capital investors also might like the idea of being able to shape early stage companies. Keep in mind, though, that LPs generally don't have hands-on role, just the GPs. And then we move to importance of venture capital. The first, experts guidance. Investors often come with industry experience. This helps startups avoid mistakes and refine their business strategies. Then second, focus on innovation. Venture capital funding allows startups to focus on developing unique products or services without worrying about short-term profits. And then third, networking opportunities. Venture capitals connect us with other investors, partners, potential customers, thereby opening doors that may otherwise stay closed. And fourth, faster scaling. With more capital, businesses can quickly hire the right talent, invest in R&D, and ramp up operations to outpace their competitors. And fifth, boost credibility. Securing venture capital can make a startup look more attractive to other investors, customers, and partners. This clearly signals it is worth betting on. And then six, risk mitigation. Instead of handling all the financial risk alone, founders shape and share the burden with investors, thereby allowing them to take calculated risks for growth. I think it is enough. Thanks for watching.